The lines at coin shops in January 1980 in the United States and in Europe, they were being compared to the lines of Star Wars and Apocalypse Now. I mean, these lines went out the front door and wrapped around the block. It was a panic because the dollar actually came very, very close to failing. The Hunt brothers were used as a scapegoat to save the dollar by capping the price of gold. If a guy rushed into a coin shop and said, I want to buy gold too, and he had 500 or 1,000 bucks, they would drop 1 or 2 coins in his hand, and that's it. And you go, oh, is that all I can get? How much is the silver? Well, the silver, you can get 40 of those for one of these. Oh, well, I'll take the silver. And so that is the reason for this spike down, which is silver going up faster than gold, measured in dollars. And this isn't over until it's over. Now, we had the big spectacular price run up in January of silver, and it hit 122 bucks an ounce. And I've been saying for years, silver is destined for triple digits. It will be in the triple digits, and it's all just a matter of the underlying fundamentals. Now, Jeff Christian, in a panel that we were on, responded to that as triple-digit silver is Coke-induced nonsense. Well, I've already been proven right, but for a short period of time, before the end of this year, I believe that we are going to be back up in the triple digits in silver.
What if I told you we're heading back to a moment like 1980, when people lined up around the block just to buy gold and silver? Back then, the US dollar nearly collapsed, and today, according to Mike Maloney, we're seeing the same warning signs again. And this time, silver could explode into triple digits.
The gold-silver ratio. These things have to resolve. For this bull market to be over, for it to be too late to make the big gains on gold and silver, these things have to resolve. Here we've got the price of gold divided by the price of silver, so the gold-silver ratio. And when it's up near the top, silver is way undervalued compared to gold. And I need to point out, we're at 60.41. How often has it been 60 or above in the past 2,500 years? Well, this can actually be measured. There's some years here going back to the late 80s, and then there are some years in the 30s. But it isn't even like 1% of the time that gold and silver have been money. We have been, for this entire century, we've been in this incredibly rare event and rare opportunity to purchase silver when it is so incredibly undervalued to gold. Now, it takes I discovered all this. I started tracking all of this back in the early 2000s. And I started buying gold when it was, the spot price was $315 when I first bought gold back in October 2002. And then I discovered how undervalued silver was in early 2003. And I started buying silver when it was below $4.40. It was $4.37 or something like that, the spot price. It was below $4.40. And I've been accumulating ever since. But like I said, these things aren't over until they're over. Now, the reason I drew this purple rectangle here is back in the 70s when gold became free trading, August 15th of 1971. So that's right up in here. Silver was going up and down and so on. It was already freely traded. So that's the reason for this bouncing around. When gold was actually fixed. But then gold became freely traded as well. And during the 70s, what the markets thought was sort of fair value, a fair balance between gold and silver, is that about 30 to 40 ounces of silver should be required to equal the same value as 1 ounce of gold, the same price, not value. There's a big difference, actually, and I've been teaching that for many, many years. In the precious metals bull of the 1970s, where gold rose 25 times its original price, and silver was, I believe it was 32 or something like that. I can't remember exactly. But from from 1970 to 1980, it was Canada and Western Europe that drove the entire precious metals bull, and the price was set by the LBMA. It was set in London. It was not being set in the United States. And then it became legal on the first day of 1975. It became legal once again in the United States to own and to trade gold, and then in 1976 in Australia. And so it was less than 10% of the world's population driving the price back then. It was illegal in the USSR and China under Mao, and there was only certain types of gold that was permitted in India that was legal for like wedding season and so on. And then the rest of the world was so poor back then that people were more worried about how to eat tomorrow than what to invest in. They didn't buy gold and silver. So it was 90% of the world's population was excluded. Today, it is everyone except there's this one little red thing here where it's illegal. That's North Korea. The rest of the world can buy. And now there's exchanges. It isn't just the London exchange. It's the COMEX. It's the Shanghai exchange. It's Hong Kong. It is, there's Australia. There's an exchange in Moscow. There are exchanges all over the world trading gold, and it's happening 24/7 now. Then there's the number of billionaires. There were a few, I believe there were 7 in the United States, and then there were another 6 back in 1980 when gold peaked at $873. There were another 6 in Europe, mostly in Switzerland, I believe. And now, look at this. I mean, you've got, there's greater than 600 in these countries, and there's billionaires in Africa now. I mean, this is an entirely different world. And all of these people can direct very large amounts of capital at a whim. They can just, so if something comes along that scares the entire world, billions upon billions of dollars can be suddenly directed toward gold and silver.
In January 1980, panic hit the financial system. Coin shops were overwhelmed. People rushed in, desperate to protect their wealth as confidence in the dollar faded. Gold quickly became scarce. Buyers were limited to just a few coins. So what did they do? They turned to silver. Because silver was cheaper, more accessible, and massively undervalued. Demand surged, and silver prices skyrocketed faster than gold. And that exact setup may be happening again. Maloney argues silver already proved its potential by hitting $122 per ounce during a previous spike, and he believes that wasn't the end. In fact, he says silver is destined for triple digits again, driven by fundamentals that are even stronger today. One of the biggest signals? The gold-silver ratio, currently sitting around 60+. Historically, that's extremely rare, happening less than 1% of the time over 2,500 years. And when the ratio is this high, it means one thing. Silver is deeply undervalued compared to gold. In past bull markets, like the 1970s, the ratio normalized closer to 30 to 40. Meaning silver dramatically outperformed gold as the cycle matured. But today's setup is even more explosive. Back then, less than 10% of the global population could even buy gold and silver. Today, it's a fully global market, trading 24/7 across major exchanges, from London to Shanghai. And more importantly, there are now hundreds of billionaires and trillions in capital that can instantly flow into precious metals during a crisis. At the same time, traditional markets are flashing warning signs. The Buffett Indicator, which compares stock market value to GDP, is sitting near 230%, far above historical norms. That suggests one of two things must happen. Either the stock market crashes, or gold and silver surge dramatically, or both. Maloney believes we're entering a massive wealth transfer cycle, where capital shifts out of overvalued assets like stocks and into undervalued hard assets like gold and silver. And if history repeats, silver won't just rise. It could explode.
So anyway, what you see here is this goes back to 1968. And in 1971, gold became free trading and took off and went from $35 up to just a whisker away from $200. While the Dow had bumped its head on 1,000 points and gone sideways for 16 years with one major pullback happening in 74. So when you divide these two, you're showing the balance, whether one is in a bubble or undervalued. And what you see here is that in the 70s, gold became free trading and started to take off like a rocket. And then gold is going up, and the Dow also fell by almost 50% during the 74 bull market. And then the Dow bottomed and gold peaked. Gold was at about just a whisker away from $200, and then fell all the way to 103. That's the reason this ratio rises. And then the Dow was rising, gold was falling. And then here, the Dow goes sideways. This is all just gold rising while the Dow is bumping along sideways at 1,000 points, basically. And it went to an intraday ratio of 1-to-1. There was a day in January 1980 where gold hit $873 and the Dow was at 873 points. So this is just showing the economic balance between the two. And then we went into the greatest stock market bull in history, and the Dow went from 1,000 to 10,000, while gold was in a 20-year bear market going from 850 down to 250. And so that's the reason this ratio rises. Gold extremely undervalued here. Stock market extremely overvalued in the NASDAQ bubble. The bubble pops. We've gone up and down, but what's interesting, look at the cycle here. You've got this one big move down, a retracement up, and then a big move down. Here, you've got this one big move down, a retracement up, and we're beginning. I believe that we are just beginning this, and we are destined for something, under this ratio of 5. I think you may see this go to a ratio of 0.5 instead of 1. In other words, the price of gold will be double the points of the Dow one day. That's within the realm of possibilities because it's been more out of whack than at any time in history when it goes back into balance. And so for that to happen, either the Dow has to fall dramatically, gold has to rise dramatically, or both can happen simultaneously, and it doesn't have to be as dramatic a move for either one of them. So this is the Buffett Indicator. It's a measurement of the value of the stock market using the Wilshire 5000 Total Market Cap Index, which the Wilshire 5000, there aren't 5,000 publicly listed stocks anymore. So it really includes all of the publicly listed stocks. There's about 3,500 companies because of all the mergers and acquisitions that have happened. But you can see the balance. So you're dividing this into the GDP of the country. Well, what are companies? Companies are the GDP of the country. This is only the publicly listed companies. The research that I did on the book ended in 2022. By then, we had hit 200% of GDP. Only the publicly listed companies being worth twice as much as a whole year of the entire U.S. economy, including all the little mom and pop, all places that aren't publicly listed. And so this is insane. It should never happen. You'll notice that there is this upward curve of this that other people are saying is sort of normal. I believe that is dangerous. I'll show you why in a moment. But fair value is somewhere between like 35 or 40% of GDP and this 85 or 90%. So really 50 to 60%, 70%, this range is fair value. And we have been in something I call the bubble century ever since the late 90s, when it seems like everybody went insane for stocks. And I'm going to prove that in a moment. So this is, I like this website. It's buffettindicator.net. And they've got this gauge here of significantly overvalued to significantly undervalued. And they're saying that the current ratio is 218%. There's another website I'll go to in a minute that shows it higher than that. And then they're using this Buffett Indicator, where you're taking the data and it only goes back to 1970. There's another one where you're using some data provided by the Federal Reserve that measures things differently. It gives you almost exactly the same data as when you're using the Wilshire 5000, except it goes back to 1947. And so I like that, and this website uses it. And so current market valuation, Buffett Indicator, and it's currently at 230%, according to this measurement, with a slightly different data set. And what you see here is, and people have been doing this for years, I believe this is very dangerous because you're making people feel more comfortable than they should be. I'm going to show you why in just a moment. But the historical trend line here, they've taken an average, and you've got this rising historical trend line as though this should be rising, as though it makes some sort of logical sense. And we're already two standard deviations, about more than two standard deviations. The stock market needs to fall by half to get in balance with the rest of the economy, just to get into balance. To go to undervalued, you'd have this incredible crash. Either that, or we have to grow GDP at an incredible rate, which will happen.
So the big question is, are we early or already late? Because if this cycle plays out like history suggests, the biggest gains in silver may still be ahead. If you want more breakdowns like this on gold, silver, and the global economy, make sure to subscribe, because the next move in this market could change everything.